A good technical analysis must have the following: ability to identify the trend of the markets, a good entry criteria, and finally, a good exit criteria. Welcome to PointFX tutorial. Today we'll be looking at what a good technical analysis means. In order to make money in the market, you need a good technical analysis. You need to understand how the market moves. And because of that, you must make sure that you have these three concepts in place, which number one is the ability to identify the trend of the market. You need this in order to identify the pattern or the direction the market is following in order to buy at a cheaper price or sell at a higher price in order to make money in the market. Number two is a good entry criteria. Now, you need a good entry criteria in order to make money in the market. Now, your entry can be based on many things. It can be based on chart patterns. It can be based on indicators. It can be based on demand and supply. It can be based on normal ICT concepts. Whichever entry you have, you must make sure that you really understand and you really developed that concept or that entry criteria. You need it in order to make money in the long run in the market. The number three is a good exit criteria. Now, in order to make money in the market, when you buy low, you need to understand when the market will cease to go in your direction, and by so doing, you need to exit then from the market. So because of that, you really need to close your positions in order to have the money in your balance. For you to make money in any trading, you must understand the ability to read the market trend. You must have a good entry criteria as well as what? An exit criteria. Now we're going to dive into the trend of the markets. There are three types of trends in the markets. You need to understand these types of trend in order to make money. Which number one is uptrend. Number two is downtrend. Number three is consolidation or ranging markets. How do you classify a market to be an uptrend? We note that this is an uptrend in two ways. Whenever your counter market make a move up and comes down, that means markets move from this low and made a high, imprinted a high. So if this market happens to go up again, you now see that it created another high at this zone. Now, if you watch this high it created, it is higher than this previous high it created. So we'll term this to be what? Higher high. So if market retraces back to make another low, and at that point in time, you now see that this current low is higher than the previous low, we'll term it what? Higher low. The market decides to make another imprint up and comes down, goes up, comes down, goes up. Now, this kind of trending markets, we regard them as an uptrend. Why? The market is making what? Higher highs and what? Higher lows. How do we know that this is a higher high and a higher low? Now, if you watch, market made a high here, made a low, he made another high, but this time around, this high is higher than the previous high. We'll call it what? Higher high. He made a low, and this point, this low is higher than the previous low. We'll call it what? A higher low. Now, market imprinted another high. This time around, it's still higher than the previous high. We'll call it what? Higher high. Made another higher low, made another what? Higher high. So in situation that market is making higher highs and what? Higher lows, we'll say that the market is in an uptrend. So what do you expect in an uptrend market? You expect to look at a zone that market has retraced so as to buy and make money in the market. Now you can see that this is an impulsive move. This is a retracement, impulsive move. So in an uptrend, you are expected to buy at the zone of what? Retracement. Expected to buy at the zone of retracement in order to what? Make money in the market. So in uptrend, we will look forward to what? Buying the market. So that is the major reason you have to identify the trend. Another way to identify the market trend when it is up is by studying the market structure. Look at this. If market makes a high as usual this way and retraces back, Now you can watch that the beginning of this zone to the height of this particular zone is a market structure. So anytime markets happen to break this structure up, as you can see, market broke this structure or this line at the resistance zone. It broke it up, and anytime market breaks it, you now know that market has breaking the structure, break of structure. I call it break in market structure up. So, and market finally retraces again, creating another what range or another structure here to here. If market breaks the structure again, we now say the market has broken another structure. Are you seeing it? Market retraces again, creating another structure, breaks up again. We say breaking what? Market structure. So whenever a market is what? Creating a break in market structure to the upward, we will regard this thing as what? An uptrend. So because of that, we will look forward to what? Buying at the end of what? Retracement. Now, how do you identify when the market is due to buy after retracement? That is where the second concept of the three things you need to know for a good technical analysis comes to play: a good entry criteria. We are going to talk about that in another video. So the summary, in uptrend market is either creating a higher high and what? A higher low, or you can identify it by checking for a break in market structure upward. Those are the ways you can identify what? An uptrend what? Market. Now we'll look at what? A downtrend market. Now, what are the things you can use to identify a downtrending market, and why do we have to identify it? Now take a look at this diagram. Market imprinted a high here and imprinted what? A low. Now at the end, market cleared this low to imprint another low. This time around, this low is lower than the previous low. We'll call it what? Lower low. Now it made another high as a retracement. This time around, this high it made is lower than the previous high. We'll call it what? Lower high. Imprinted another low which is lower than the previous low. Imprinted another high that is what? Lower than the previous high. And the movement continues. So in this kind of trend, you regard them as what? A downtrend market. Now, why do we have to study it? Why do we have to understand? We have to understand it because in a downtrending market, you have to follow the flow. You have to sell after the retracement of each move. Now again, how do we understand when to actually partake in selling? That is what you learn at stage 2, which is what? A good entry criteria. Now in a downtrend market, as I said, you can identify it by formation of lower lows and what? Lower highs. And another way you can identify this downtrend in the market is by the use of what? Market structure here. Look at the top of the structure. Look at the what? Down of a structure. And market, instead of taking out the up of this structure, it takes down the structure down. We'll regard this as what? Break in what? Market structure down. Break in market structure. And after that, market retraces and creates another structure. Look at the top of the structure, look at the bottom of the structure, or the range from here to here, and market breaks another structure this way. You regard them again as what? Breaking market structure. And market kept on breaking the structure down. Look at it. Break another one. We'll call it what? Breaking what? Market structure. So at this juncture, when you are spotting either lower lows and lower highs, or break a market structure downward, we say that the market is what? In a downtrend. Another feature of this downtrend is what we call breaking market structure downward. In summary of this, in a downtrending market, what do we look out for? We're looking out for a market making lower lows and what? Lower highs, or market creating what? Breaking market structure downward. Now, why do we have to understand this? We have to understand that we need to sell in the downtrend market in order to make money. How do we now know when to sell and when to buy? We know about that by having a good entry criteria, which is what we're going to talk about in the next video. The final concept of the trend is what we call ranging markets or consolidation. When you encounter a market moving this way, Now, if you can see, the market is converging at the top and also at the bottom. So market is failing to break a structure. In raging market is neither creating higher highs nor lower lows. So the market is simply moving in a range. You see here a support, resistance, back to support, resistance, back to support, resistance, back to support, resistance. So there are two ways you can trade this market. One of the ways is ability to identify when the market is in a range at the bottom or when it is in a support, so that you can buy and take your profit when it comes to what's resistance zone. Also, the same way applicable, ability to identify when the market is in a resistance zone so that you can sell and take your profit in what? A support zone. So how do we know that market has approached a resistance zone or a support zone? We only know that by having a good entry criteria. So what are these entry criteria? These entry criteria can be derived from various formats, which we are going to talk deeply in our next video. Thanks for watching this video up to this point. If you really like the content you just watched, you can like, share and subscribe so that you get other contents that will be coming up, especially on how to develop a good entry criteria in the forex market in order to make money. Thanks very much for watching up to this point. It's your boy Point FX.